Hi, it's Tanya Gordon here with my financial advisor, Barry Gordon, who also happens to be my husband. Um, anyway, I wanted to get him on to talk to us because in business, there's obviously a lot of risk, as we discussed last time, and we need to mitigate all as much risk as we can, really. One of the things, the big risks, is obviously financial risk, but it isn't just to the business or yourself. Obviously, it can affect your whole family. When I started dealing with Barry, it was because one of my friends at work had actually been diagnosed with terminal cancer and he was only 48. Um, and I had young kids at the time, and I realized that if I was out of work, if I couldn't work, then who was going to pay my bills, and that put a lot of risk with my children. So before that, I'd only had the insurance, the life insurance you kind of really should have with a mortgage. So that's where Barry came in, and I wanted to have a chat with him today to talk to us about a few things that can help, really. Obviously, initially about the protecting our income with for families and people with businesses, really.
Good. Yeah, no, I think one of the building blocks of anyone's business, but also their own personal financial plan, should be having that sort of understanding that things do go wrong. And we all hope it's not us, but I know cancer numbers are maybe 1 in 3. So there's a good chance that at some point in your life, you're going to have something hit you that you don't expect. And that foundation of your financial plan should have those considerations in place. What if I do contract a serious illness? Obviously, this year, COVID's, really raised the prospect of serious illness for people. So I think we'll see more and more people taking on those type of plans. But critical illness, yeah, key part of someone's plan. Often we target covering debts. So if a business has taken loans, if you become seriously ill, how are you going to pay those loans back? It might be your mortgage. And critical illness cover tends to be a lump sum payment on a specific illness. Then we've also got things like income protection. When you're not working, you're not getting any income if you're self-employed. And I think having that lifeboat running alongside your business to pick you up if you do have a Titanic-like event, is a vital part and should be thought, as a main thing for everybody.
Yeah, I know for me, obviously, it's a while ago when we put this in now, so I'll try to remember. But for me, there was the life insurance with the critical illness cover, which I remember we worked out a lot on how much we needed to for the family to survive a year or 2 years or however long you think this illness may last before you hopefully recover. But obviously, it can go the other way. And then also we did the work element so that I'd got income protection in place that either I could take out to the business in the form of income or dividend, but also we could use it to fund replacing me, because essentially the problem is with a lot of owner managed businesses, the business can't survive without you either. And to replace you, in some cases, would be more expensive than paying you, depending on what people are taking out personally at any one time.
I think you're. I think yeah. I think the cost of, in the event of these things going wrong, the cost of replacing yourself or bringing somebody else in to do those jobs can be just astronomical and destroy the business.
Yeah, and you've got to bear in mind that it might happen at a time where if you were in a coma from a car crash, if you were incapacitated, you can't actually do any handover, really. You're hoping someone is going to take those reins and sort out a replacement. But if you actually think of that happening, in many cases, there isn't the structure in place to even make that possible.
No, and I think sometimes people are concerned at the cost of doing these things, but the reality is the cost of not doing them, if it does happen, they're astronomical. I mean, you've got a limited company, so sensible to sort of use some sort of, or at least consider some sort of executive income protection. Key difference there is that's the business is taking the policy on effectively, and the benefits being paid into the business for you to do with what you will. at that moment in time. It might be that that just replaces your income. It might be it pays a member of staff, a new member of staff, to come in and take over your role, and therefore you carry the business growing.
Yeah.
If
I mean,
you're
in
not,
my case, I've kind of got both covers, which is like beneficial. But it's interesting as well, because I remember when we looked at it, we sort of touched on that figure of, right, how much do you think the family needs and how much does the business need as well when we did both. But also at that point, obviously, you've got premiums to consider. But the thing is, people often say, oh, it's too expensive or whatever. But actually, anything's better than nothing, surely. So if you were to say, okay, well, I can't afford a premium of £50 a month or whatever, then, well, what could I get for 35? What cover?
yeah, I think it's scaling the cover to suit your budget at the start, and you pay what you can afford. Sometimes people need a nudge in the right direction, that if they're saying they can't afford that, well, when they're ill, they can't afford anything, and the family can't afford anything.
Yeah.
So they need a nudge sometimes to go, actually, how this is a serious, an important thing.
My dog's insured. I think he costs me about £18 a month, but
Just to say the
my
same.
dog's insured.
Yeah, you've got house insurance, car insurance, pet insurance, TV insurance, holiday insurance. If you lost your holiday, you lose a few grand. The
Yeah.
thing people haven't covered is their biggest asset, and the
Yeah.
biggest asset is their salary. Often, you need to cover that salary, because without that salary, you have nothing.
Something
So,
as well, I was thinking as well, is a lot of people, they don't consider, if, for example, okay, we're not going to be sexist here. So if one part of the family doesn't work, and they're a stay-at-home parent, then they often aren't insured because they're not going to lose any income. But if one of you's ill, whether you earn money or not, the other person is going to have to seriously up their game with childcare and things like that. And they're not going to be able to work necessarily in the capacity they previously did for a period of time.
yeah, no, and I think if people aren't working, they might not be able to cover themselves with something like an income protection type plan. But if it's a serious illness, critical illness cover would hopefully pay out a lump sum. Insurance companies have got better and better at paying out. The claims are huge. Most people wouldn't have a clue about the millions that are being paid out by insurance companies. So yeah, it's not just covering the main breadwinner; it is also covering potentially, I don't know, the main carer, whoever that may be.
Yeah. So, I mean, obviously financial planning is just a massive, massive area in its own. Um, we could be here all night or do a nightly thing for weeks going on about all the different things that people can benefit from. But obviously, we're primarily aiming at business owners, and with that, we're saying that everybody has an accountant in business because you need one to file your accounts. They don't always think to have a financial planner, but really it's just as important, because in my mind, a lot of people grow their business to either sell, like they're trying to grow their business to sell, or a lot of them want to work less hours or whatever you. But realistically, having a business, the idea is that you're securing your future wealth for your family. And I feel like a lot of people reinvest in the business a lot, which at the start, particularly, is very important. And, there are times where you have to do more reinvestment than others. But I think it's very important to talk about getting money out of the business in a tax efficient way, and not just for your now, for your holidays and your cars and all this rubbish that people focus on, but actually for your future. Because if businesses go bust, etc., dividends aren't necessarily safe. Sometimes they do have to be paid back if it's proved that you've done something wrong. But if you've put your money into your pension, it's tax efficient for both the company and personally, but also then that money's there for your future. Can you tell us a bit more about that?
Yeah, I think there's a few things there. I think firstly, um, everyone does seem to have an accountant. Accountants, yeah, I've got my own accountant. I wouldn't be without him. I think that the missing link in most businesses and for most people in the UK is they don't have a relationship with a financial planner. And I think what we do is different to what accountants do. And I think the accountants will look at your tax position now and tend to look back in time. We tend to look forward. And those two services should really dovetail. And one of those things is, leading into what can you do with surplus money as the business generates more and more profit. Pension is a very tax efficient means of moving money from your company coffers into your private coffers. And yes, you've always got that dilemma between cash flow. Can I afford to put money to one side? Because once money goes into pension, it's there till 55 at the moment. That's the earliest you can get your hands on it. You don't want to put too much in there and suddenly find you can't get your hands on it. Past experience of doing that myself many years ago. One February I put, I don't know, wasn't a lot maybe in those days, a few £1,000s of extra money I'd saved into pension, and then lo and behold, the next month was terrible. So, but you get through it, and it's that money there that's grown over the last 20 odd years. So I think pension's vital. If you're a limited company, it's saving your corporation tax. It's also moving money out of that business to yourself without you paying either income tax, whether it be dividend, tax on your dividends or tax on your income, and potentially national insurance as well. So for me, forget all the tax reasons. You're working for 40 years and you're living hopefully after that for 20 to 40 years. If you don't put enough aside in the 40 years you're working, well, your next 20, 30, 40 years aren't going to be very good. You're going to be living on state benefits, which are an important part of the picture, and they do help people, but they're certainly not enough to have a fabulous retirement. So at the end of the day, spend a little bit less, put aside a little bit more, and you'll do okay.
Yeah, that's good advice. I was just thinking with what you said about the dilemma every year, and I've done it myself. You sit there coming up to year end thinking, how much do I put in? And some businesses have got better forecasting and order books than others. If you're in that position, then yeah, great. If you're not, then you've it's more of a gamble, isn't it? If you've got a 6-month order book, you can kind of you're not winging it so much, so to speak. So
I think the thing is ultimately, people want to find the right time to do things. It's a bit like having kids. There is no right time. So sometimes if you keep on delaying, all you're doing is costing yourself more money. Nobody else, just yourself. So you do have to at some point sort of go, do you know what? I'm putting this in. And if that causes me a problem, or hopefully not a major problem, be sensible about it. But if that does cause you a bit of a problem in the short term, you have to then pull yourself together and get more income or more business in. I've done that myself a number of times. You can't put off forever.
No, sometimes it is quite good to give yourself that pressure, isn't it? Of the fact you've allocated that money's gone now, so you just have to earn more. You have no choice; it's gone. Yeah. I personally, I felt I've never really panicked about my pension because I started investing before, obviously, I met you anyway, and moved my pension across to you. But I was fairly early in my 20s, I think. I couldn't even tell you when, but it's just something I've always done. I know that obviously the earlier you do these things, the better. And it's the same with like life cover, because in theory, when you get that premium, you're never healthier than you are the younger you are. So in theory, you're going to get a better rate the earlier you do it. But with your pension, obviously, some people aren't in a position to start earlier, but it's never really too late either, is it?
No, I think no, it's never too late to start. In fact, I've just had that conversation tonight with a long-standing client really about his new partner. She's maybe 10 years away from when she could draw a pension. The question is what else will grow as quick in that time period? And the answer is nothing else really gets that sort of tax relief, tax benefit So even though she doesn't earn at the moment, she can still make a small pension contribution each year, and that benefits by an uplift of 25%, which is in essence repaying the basic rate tax, even though she's a non-taxpayer. So, that's a great little, benefit, because you can pay money in, it's uplifted 25%. She did that for 10 years. It's not going to give her the biggest pot in the world, but as a couple, it's part of their overall picture. And she also might be able to access quite a bit of that tax-free as well as the tax-free lump sum. So just a nice little benefit to their savings. What else are they going to do? Leave it in the bank, interest rates, I don't know, less than 1%. Whereas gain 25% immediately, they're up 25%. So there's no real comparison. I think people have those things in their minds. Oh, I'm too late, it's a bit late. No, it's never too late. Yes, if you'd started earlier, you'd save yourself more money, or you'd have a bigger pot at the end of the day. But there's never a wrong time to do the sort of right thing.
No, that makes sense. I mean, a lot of people as well, there's the buy to let thing, isn't that? I mean, I've done it myself. Obviously, years ago it was a great thing to get into. Now they've they tax it heavily. They tax you extra stamp duty on purchase. There's extra tax that there just wasn't years ago. And I'm not saying it's not a good thing to do now, but not when you look at if you didn't have a pension. Some people do treat it as let's do this as a pension, just for tax reasons alone. You're not getting that, you're getting extra tax instead of tax benefits.
I think, like all investments, there's pros and cons for most of them. Property, for the British, we've always loved our property. And I think that's, like you say, go back a number of years, there's been some tremendous gains people have made on their own property. Often, however, those gains are greater than people realise. They don't do the maths correctly to work it out. The yield on those properties is not quite as good when you factor in costs of repair, costs of maintenance,
bad tenants,
even just missing a month maybe in between tenants, taxation on the rent. Interest rates have been low for a while, so that's been beneficial. So one good thing about property, if you borrow and gear up, you're effectively borrowing to buy a bigger house than your deposit can actually buy you. So you do get capital growth in the long term on that. But capital growth isn't always as fast as people might expect. And then capital growth on second properties, the tax rates are higher than things like shares and unit trusts, for example. So I'd say, some properties could be very good, but to put all your eggs in one basket and say, that's my pension, unless and there are people who do have a hell of a lot of properties, can become quite successful on the back of it. Even those people still shouldn't close their eyes to the tax benefits of other things that are out there.
Much rather those people are obviously in that category then, where they've got quite a lot of wealth to be able to look at other things as well, and they are spreading the risk, aren't they? But a lot of people go like, I'm going to do this is my first buy to let, or get a couple or a few, and at that point you really are, they're the people that may not go if they were going to invest in a pension. Obviously, when you do this, then you get talk, how much risk are you comfortable with? Do you want an adventurous portfolio or a more moderate one? Those people might not say that they were adventurous, and they might not want an adventurous portfolio, but what's more adventurous than what they were currently doing?
I think with property, people will buy one house and don't view it as any risk whatsoever. And that is definitely wrong. And they might try and build up a small portfolio of a few properties, and that is sort of trying to dilute the risk. But ultimately, the people who become very, do generate wealth, they rarely feel as wealthy as they are. And it's because they can't get their hands on any of their money. It's all tied up. They end up becoming DIY men. That's not my idea of a successful person, is someone who basically, sorts out problems when they go wrong. If I was to say to some of my clients with properties now, later on in life, if they could swap £1 million of equity for £1 million pension, most would go to the pension for £1 million of pension fund.
Very, very good, isn't it? Hindsight's a very good thing, isn't it?
It's because they've, don't get me wrong, they might be builders, they might have done well on the back of it, and that's not knocking them. They've done a good job, and they've used their skills and their ability and their industry and their knowledge to gain wealth. The fact that that's taxed isn't really their fault. It's just the way things are. And my job with those is not to say to them, you've done something wrong, because they haven't. They've made money off the back of it. But it's then, how can we use that money to maybe prevent the tax bills you're going to pay? Because £1 million in property, inheritance tax is 40% for many of them once it's over their nil rate bands. If that was £1 million in a pension, there's no inheritance tax on it. That's a 400 grand saving for your family. So, all I'd say is people shouldn't get stuck down one route.
Yeah, that is obscene, isn't it? 400 grand of saving of tax. Some people obviously have the opinion that it's.
I think people try and avoid. People don't like to pay capital gains tax, so they will maybe say, I'm not going to sell that house because I'll pay capital gains tax. When you die, capital gains tax vanishes and it's replaced with inheritance tax. Yes, if you're not wealthy, or that's a bit rude, if your wealth isn't over the thresholds, you're not going to pay any inheritance tax. So you need to know what that is. Most people don't. But if it is over, your capital gains tax bill's gone, which on property is about 28% for a high rate taxpayer and 18% for a basic rate taxpayer, and it turns into a 40% inheritance tax bill.
Oh, that's good. It's gone up by 12.
You could have done something about it. If you house it in the right sort of areas, maybe give it away, maybe start to pass some of that wealth down. So there's all sorts of clever means of managing your money in the most tax efficient way.
And I think a lot of what we've talked about as well is clarified that really no two people are the same, are they? Every person, every business is different, and their need and their requirement is different. And really that is kind of the point of why you need to deal with a professional yourself to actually look at your personal situation and how best you can plan your own finances.
Yeah, I mean, to me, the business. I mean, you help businesses and look at how they're running their business to become more efficient and more profitable. My job's not necessarily to help them in their business, but it's to look at their business and say, are they using the funds within the business wisely? Do the funds that they take out of the business then become personal? But these things are interlinked. So, how is that meeting their personal long-term plans financially? So that's sort of what my job is. I think the thing is, we're all a bit scared. People are scared of talking to a financial advisor. Yeah, things have been done wrong in the past by people, in yesteryear. The majority of that is gone. People are far more better qualified in the financial advice world. Do they bring a business consultant in? Well, do you know what? Have a chat. If you don't like what you hear, don't do anything. But have a chat, because often these people know that a little bit more than you maybe as an individual, and seek help. We're all a bit, I think, in Britain, a little bit sort of, we'll do it ourselves.
Well, there's no trust almost for, almost every single profession has got trust issues.
Yeah, we the professions do. And some of that is deserved, possibly over the years. I've come across all sorts of weird and wonderful things. But unfortunately,
people don't trust people anymore.
Word of mouth, get a financial advisor via word of mouth, get a business consultant because you know her, you know him, or you've been recommended, or they talk, the way they talk on, a lot of the modern technology, LinkedIn and things like that. Do they like what they see? If they do, have a chat. It doesn't cost any money to have a coffee. And if something comes out of it that then means you pay for something, you've evaluated whether that's worth paying for. And certainly, I think every single person in the country should have a financial advisor, bar none. Yes, okay, I suppose some people might not have any wealth to do anything with.
I think a lot of people, there's a misconception, isn't there, that you have to be, in their mind, wealthier than they are, whatever level they are. A lot of people think they're not at the level to require that sort of help, and really that's just not the case, is it?
No, I mean, money's relative to what those people are used to. I've had clients with relatively little a long time ago, and they've slowly spent, well, they've spent less than they've earned. Bit by bit, they've put into the right sort of things. It takes a bit of a leap of faith. We're in a world where everyone wants everything tomorrow.
Yeah.
I'm afraid finances and wealth doesn't build up like that. Even the richest men in the world, excuse me, they they invest and it takes time. And I think that's, people have got to have a bit of patience, a bit of trust, and give it a little bit of time, and it works. And if they're doing that while running their business and they're running that efficiently and well, it's the best thing knowing that you're running your business to make your money, but at the same time, your other money is making you more money and you're not doing anything for it. That's what always appealed to me. I love the idea that, when I'm working, doing my job, trying to earn more money, my other funds are growing and earning me another income or more money.
Yeah.
That makes sense.
It's that exponential growth thing as well, isn't it? About the earlier you put in's great, but when you look at people like Warren Buffett, how isn't it that he's earned a massive portion of his wealth after he turned 60?
Oh yeah, I don't know the exact figures, but some of his, it probably is, he's maybe, I don't know, he's over 85, I think now. In say the last 20 years, he's probably done at least half of his wealth. Crazy as though that might sound. He's been investing for over 60 years. It's that type of long term. Money makes money. We all know that saying. What that means is that if you've got 100,000, it grows by 10%, it makes £10,000. If that's £1 million and you make the same percentage return, it makes £100,000. Einstein said it was the eighth wonder of the world. I think it was Einstein anyway, but somebody clever. It takes some time to get going. Your first 20 years, you can seem to get nowhere, but
And that's the
slowly.
thing, isn't it, with people wanting things now, and it isn't a fault, it's just how it is. But like you say, you cannot really speed this up other than by putting more money in. So unless you start,
Yeah, people have a choice at the end of the day. They want things now. I understand that. Treat yourself as well. It's not just about invest, invest, invest. If you don't actually
you still need
spend,
some holidays.
if you don't do anything with your money, it doesn't mean anything. There's a few people who maybe could just invest and they get enjoyment out of that solely. But for everybody else, it's finding that right balance. I've seen some young clients in the last year under the age of 24, and all of them have started new jobs, come out of university or college or whatever it might be. They're not earning huge amounts of money, but they've looked at their finances quite early and they've been able to save relatively good amounts per month that will make a big difference in the next, in the coming years. So yeah, it's good to start early, but it's never too late.
Well, thanks so much for your time. The general gist is start when you can. It's never too late. And to use your business to actually secure your personal future wealth. It isn't all about your business, because whilst your business may be your baby, at some point you'll retire or sell, or it won't be. Things go wrong. Get your money out. So that's the take home from today.
Yeah.
See you soon.